Mark the date on your calendar. Friday, December 12th, 2025. To the average person, it will look like just another day. The markets will open, people will go to work, and the news will talk about the weather or politics. But in the quiet, marble-lined halls of the Federal Reserve Bank of New York, a switch is going to be flipped. For the first time in years, the United States Central Bank is officially restarting the engine of money creation. They aren't holding a press conference to celebrate it. They aren't calling it stimulus, and they certainly aren't calling it quantitative easing. They have buried it under a layer of technical jargon so dense that they hope you won't notice. They call it reserve management purchases, or RMP. They say it's just a plumbing fix. They say it's a technical adjustment to help with tax season. They say it has nothing to do with the economy, the stock market, or the inflation that is eating away at your grocery bill. They are lying. On December 12th, the Federal Reserve will begin injecting $40 billion a month of newly created money into the financial system. This is not a plumbing fix. This is a fire hose. And it is being turned on at a moment when the stock market is hovering near all-time highs, when inflation is still burning above target, and when the U.S. government is borrowing money at a pace that would bankrupt any other nation on earth. What happens when you pour gasoline on a fire? You get a meltup, a final explosive surge in asset prices that defies logic, defies gravity, and blinds investors to the cliff edge that lies ahead. Welcome to the Financial Coin Historian. Today, we are not just reading the headlines, we are decoding the signal. We are going to deconstruct the Federal Reserve's December announcement line by line. We will explain the difference between RMP and QE and why, for your wallet, it doesn't matter. We will explore the crowding out effect that is about to force billions of dollars into the stock market. And we will issue a warning about what comes after the meltup, the return of inflation that they can no longer control. The printer is warming up. The date is set. The only question is, are you ready for what happens on Friday? To understand what is coming on December 12th, we must first look at what happened on December 10th. The Federal Open Market Committee, the group of unelected officials who decide the price of money for the entire world, concluded their two-day meeting. The headline was simple. The Fed cut interest rates by 0.25%, lowering the target range to 3.50% to 3.75%. On the surface, this sounds like good news. A rate cut suggests the Fed thinks inflation is beaten and wants to help the economy. But if you listened closely to Jerome Powell's press conference, and if you read the fine print of the summary of economic projections, you saw a very different picture. This was what Wall Street calls a hawkish cut, the split decision. For the first time since 2019, the decision wasn't unanimous. 3 voting members dissented. They didn't want to cut. Why? Because they see what you see. They see that inflation is sticky. They see that the supercore inflation, services excluding housing, is not going down. They see a government running a deficit of nearly $2 trillion a year. Cutting rates into that environment is dangerous. It risks reigniting the very fire they spent 2 years trying to put out. The one cut. Shock. But the real shock came in their projections for next year, 2026. The market was expecting aggressive cuts, 4, maybe 5 rate reductions. The Fed? They projected one single cut for the entire year of 2026. This should have crashed the market. It was a bucket of cold water on the idea that cheap money was coming back fast. And yet, the market didn't crash. In fact, it rallied. Why? Because of what they announced next. The technical adjustment, the restart of the balance sheet, the RMP. The market realized that while the Fed might keep interest rates high, they were about to open a different door to let the money flow. They were pivoting from price control to liquidity control. And in the world of finance, liquidity is the only thing that matters. Let's get technical for a moment, because this is where the deception lies. The Federal Reserve is terrified of the word QE, quantitative easing. QE is associated with crisis. It's what they did in 2008, when the banks collapsed. It's what they did in 2020, when the world shut down. QE is the nuclear option, printing trillions to buy long-term bonds to force interest rates down and stimulate the economy. If the Fed announced QE for right now, with the economy growing and inflation at 3%, the public would be outraged. It would look like they were giving up on inflation. It would look like panic. So they invented a new name, reserve management purchases. The official story. Here is the official explanation from the New York Fed. They say that the banking system needs a certain amount of reserves, cash held at the Fed, to function smoothly. They argue that as the economy grows, the demand for these reserves grows. They also point to the calendar. April 15th is tax day. When you pay your taxes, money leaves your bank account and goes to the government's account at the Fed, the Treasury General account. This drains liquidity from the banking system. So the Fed says, we aren't stimulating. We are just buying $40 billion of Treasury bills a month to replenish these reserves and smooth out the tax season bumps. It's just plumbing. The reality. Now, let's look at the reality. Whether you call it QE or RMP, the mechanical action is identical. The Federal Reserve creates digital money that did not exist before. It uses that money to buy U.S. government debt from the market. That money then enters the accounts of the banks that sold the debt. The result? The Fed's balance sheet gets bigger. The amount of money in the financial system increases. The duration distinction. The Fed argues the difference is duration. In QE, they buy long-term bonds, 10-year, 30-year treasuries, to lower long-term interest rates, mortgages, auto loans. In RMP, they are buying short-term treasury bills, less than 1 year. They claim that buying short-term bills doesn't stimulate the economy because it doesn't lower mortgage rates. But this ignores the most basic law of finance. Money is fungible. When the Fed buys $40 billion of T-bills, they are taking those bills out of the market and replacing them with cash. The investors who sold those bills, money market funds, banks, hedge funds, now have cash. They have to put that cash somewhere. They can't just sit on it. So where do they go? They go looking for yield. They buy corporate bonds, they buy stocks, they buy gold. This is the trick. By flooding the short end of the market with cash, the Fed effectively forces investors to move their money into riskier assets. They ignite a rally without ever officially cutting long-term rates. It is a meltup by design. Why now? Why December 12th? Why not wait until next year? The economy isn't crashing. GDP is projected to grow 2.3% in 2026. Unemployment is stable at 4.4%. Why turn on the printers when the sun is shining? Because the plumbing is leaking. The ghost of 2019. To understand December 12th, 2025, you have to go back to September 2019. Back then, the Fed was also shrinking its balance sheet, quantitative tightening. They thought everything was fine. Then, overnight, the repo market broke. The repo market is the engine room of Wall Street. It's where banks lend cash to each other overnight, using treasuries as collateral. It's a boring, safe, low-interest market. But in September 2019, the cash suddenly dried up. Repo rates spiked from 2% to 10% in a single day. The financial system nearly seized up. The Fed panicked. They had to inject billions overnight to save the system. They realized they had drained too many reserves. The 2025 warning light. Fast forward to today, the Fed has been doing QT, quantitative tightening, for 3 years, draining money to fight inflation. But in recent weeks, warning lights have been flashing in the repo market again. The reverse repo facility, a place where excess cash is parked, has been drained dry. The Fed knows that if they don't add water to the pipes now, the pipes will burst in January or February. They're terrified of another 2019 accident. So this $40 billion a month isn't about stimulating growth. It's about preventing a heart attack in the banking system. It is an admission that the system is so fragile, so addicted to liquidity, that it cannot survive without a constant infusion of fresh cash. The ample reserves trap. This reveals a deeper, more disturbing truth. The Fed has officially moved to a permanent ample reserves regime. In the old days, before 2008, the Fed kept reserves scarce. Banks had to be careful with their cash. Today, the Fed's policy is to flood the system with so much cash that banks never have to worry. This means the money printer is no longer an emergency tool. It is a permanent fixture. The Fed has effectively guaranteed that the banking system will never run out of money, no matter how much debt the government issues. And speaking of debt, you cannot talk about the Fed's December 12th decision without talking about the elephant in the room. The United States national debt. It has crossed $37 trillion. It is growing by $1 trillion every 100 days. This is where the inflation warning becomes real. We are entering a phase of economic history known as fiscal dominance. What is fiscal dominance? Fiscal dominance happens when the government's debt becomes so large that the central bank loses its independence. The central bank can no longer focus on fighting inflation. Its primary job becomes keeping the government solvent. Think about it. The U.S. government has to pay interest on that $37 trillion. If interest rates stay high, the interest payments alone will consume the entire federal budget. We are already paying more on interest than on national defense. The government needs lower rates. It needs someone to buy its bonds. But foreign buyers like China and Japan are selling. So, who is the buyer of last resort? The Fed. The RMP as a stealth bailout. By launching RMP, the Fed is stepping in to be that buyer. They are buying treasury bills. This keeps short-term borrowing costs down for the government. This is the definition of monetizing the debt. The government spends money it doesn't have. The Treasury issues debt to cover the spending. The Fed prints money to buy the debt. This is the cycle that destroyed the Roman denarius. It is the cycle that destroyed the Weimar mark. And on December 12th, the United States is formalizing this cycle as standard operating procedure. So we have money printing. We have a trapped Fed. We have a government addicted to debt. What does this mean for your portfolio in the next 3 to 6 months? It means a meltup. A meltup is a dramatic, often vertical rise in stock prices, usually occurring at the end of a bull market. It is driven not by economic fundamentals, like earnings or growth, but by a flood of liquidity and a panic to get in. The crowding out effect here is the mechanism that will drive the market starting December 12th. 1. The injection. The Fed buys $40 billion of T-bills. 2. The displacement. The investors who used to own those T-bills, money market funds, banks, now have $40 billion in cash. They earned interest on the bills. They earn nothing on the cash. They need to find a new home for that money immediately. 3. The search for yield. They look for safe assets, but the Fed just bought them all. The yields on safe assets are falling because of the Fed's demand. 4. The push to risk. To get a return, these investors are forced out on the risk curve. They buy corporate bonds. They buy blue chip stocks. 5. The ripple effect. As billions flow into blue chips, those stock prices rise. This pulls the whole index up. Retail investors see the market rising and experience FOMO, fear of missing out. They jump in. 6. The mania. The cycle feeds itself. Liquidity creates higher prices, which creates confidence, which attracts more liquidity. The Santa rally on steroids. The timing is critical. December is historically a strong month for stocks, the Santa rally. By launching this program on December 12th, the Fed is pouring jet fuel on a seasonal fire. Analysts at Evercore and other major firms are predicting that this liquidity injection could push the S&P 500 through resistance levels of 6,700 and beyond. We could see a blow-off top in early 2026 as the market digests the reality that the Fed put is back. The market doesn't care why the Fed is printing. It only cares that the Fed is printing. And $40 billion a month is a lot of printing. But while the stock market parties, the real economy will pay the price. The Fed claims RMP won't cause inflation because it doesn't lower long-term mortgage rates. This is a half-truth. It might not cause a housing boom immediately, but it will devalue the currency. The Cantillon effect. We have discussed the Cantillon effect on this channel before. It is the economic law that says new money benefits the first recipients and harms the last recipients. Who gets the new money on December 12th? 1. The primary dealers, the big banks that sell the T-bills to the Fed. They get the cash first. 2. The investors, the hedge funds and institutions who see their asset prices rise. Who gets the money last? You. You get the money only after it has circulated through the economy and raised prices. By the time this liquidity filters down to wages, the cost of living has already gone up. Asset inflation versus CPI. We are likely to see asset inflation first. Stocks, gold, Bitcoin, and real estate will rise. This widens the wealth gap. The rich, who own assets, get richer. The poor, who own cash, get poorer. But eventually, this leaks into the real economy. A rising stock market makes people feel wealthier, so they spend more. High government spending, funded by the Fed, increases demand for goods. The Fed is playing a dangerous game. They are stimulating demand while supply is still constrained. They are betting they can manage the psychology of inflation. But if the public realizes that the Fed is funding the government's debt with printed money, inflation expectations will become unanchored. Once people stop trusting the dollar, no amount of interest rate hikes can save it. The rest of the world is watching this closely. Why do you think central banks in China, Poland, Singapore, and India have been buying gold at record rates? Why are the BRICS nations trying to build payment systems outside the dollar? Because they see what is happening on December 12th. They see a superpower that cannot pay its bills without printing money. When the Fed engages in RMP QE to suppress yields, it weakens the dollar fundamentally. It tells the world that U.S. debt is not sustained by tax revenue, but by the printing press. This is why gold is hitting all-time highs. Gold is the anti-dollar. It is the only asset that is not someone else's liability. As the Fed expands its balance sheet, the real value of the dollar dilutes. Smart money is moving into hard assets, gold, silver, Bitcoin, commodities, to protect purchasing power against the coming devaluation. So, what should you do? First, recognize the environment. We are entering a period of reflation. The Fed has signaled that it will prioritize financial stability, keeping the plumbing working, over fighting inflation, keeping your prices low. This means holding cash is a guaranteed loss. The meltup will likely lift all boats in the short term: stocks, crypto, precious metals. The liquidity tide is coming in. But be careful. This is not a healthy bull market built on productivity. It is a monetary illusion built on debt monetization. Do not chase the euphoria blindly. The crowding out effect will force prices up, but it will also increase volatility. Use the rally to improve your position, to diversify into hard assets, and to reduce your own debt. Friday, December 12th, is not just a date on the calendar. It is the day the training wheels come off the money printer. The Fed has blinked. They have chosen to support the debt machine. The meltup will accelerate. The inflation warning is flashing red, and history tells us that once this cycle starts, it only ends one way, with the devaluation of the currency. This is the Financial Coin Historian. The printer starts on Friday. Don't say you weren't warned.